This is Bloomberg.
25 seconds away from the opening bow this morning. Good morning. The earnings from Facebook helping out the Nasdaq. Two names, Amazon and Apple, making up almost 20% of that particular index. They report after the close a little bit later. Equity futures on the S&P up by 1.2% this Thursday morning. Good morning to you all. There's the opening bow. Switch to the board and get to the bond market. Your 10-year yield looks like this, up 3 basis points to 285.91. Euro dollar looks like this. Very briefly, 104. Right now, just about holding on to 105. That currency pair down 0.5%. German inflation surprising to the upside this morning. CPI in Germany much higher. CPI in Germany coming in at 7.8%. The median estimate 7.6. Crude 102.13. We're up there by about 0.1%. No drama. About 24 seconds into the open. It's Katie Lyons with your movers.
Well, there are a lot of them out there because, of course, it is earnings season, John. One of the outperformers to the upside is actually Pinterest. That stock higher by nearly 9% before the bell after beats on the top and bottom line. But we have to keep in mind here the bar was very low. This was a stock down 49% year to date going into the print. So keep that in mind when we look at the price action this morning. Remember, analysts not all that positive. We've seen a number of price target cuts this morning on the back of earnings. You also have Qualcomm up after results. It's the biggest maker of chips for smartphones. Gave a really strong sales forecast for the current quarter, handily tops estimates. So that helps ease concerns that chip demand may be slowing. It's up about 7%. Southwest Airlines also higher after results. Really bullish on that travel demand recovery for the summer. It's up 2%. But one downside mover here is Caterpillar. Of course, a big industrial bellwether. It did beat on profit, but issuing a warning on China and the impact that COVID-19 lockdowns are going to have on demand. That stock down 3.5% at the opening bell, John.
Kelly, thank you. About 90 seconds in, we advanced 1.3% on the S&P 500. Communication names leading the way up by more than 3 percentage points. Staples down about 0.1%. Just to give you a picture of what's happening here early on in the session this Thursday. A big move on Facebook. Meta surging off the back of its quarterly results. That stock, Taylor Riggs, up by almost 19%.
John, you're showing your age. We have to call it Meta now. You can't call it Facebook.
I'm old, and that's fine.
Okay, boomer. Still up 19%, as you said. Of course, as we're taking a look at the shares. And like I'd mentioned earlier, for sort of a good return here to user growth and taking a look at those ad impressions that indeed did come in better than expected. You talk about that new users really helping some of that top line revenue growth despite some of the macroeconomic concerns about the war. And again, sort of cutting that second quarter outlook, but they're also cutting expenses. Perhaps maybe some of those big ambitions with the metaverse maybe won't hit the bottom line or those big expenses as much as we thought. You take a look, though, and that really puts it into perspective. Facebook, of course, is a big juggernaut that we're following. As you can see, their top line growth of more than 6%. But Microsoft, Google, also huge names that are still growing 18 to 20%. I mentioned Qualcomm earlier, still crushing it at 40% sales growth as demand for chips. Well, you know the story there. Finally, we're sort of wrapping up some of the big tech earnings, and we push forward Apple, Amazon, of course, big ones after the bell today. A good read, as you've been talking about sort of the indication of some of the lockdowns, some of the macroeconomic concerns as well, and then, of course, the big health of the consumer coming in on those numbers, too.
Don't you think GE is the ultimate boomer stock?
Okay.
Isn't that more sort of age appropriate?
You know, it's so funny. It's like IBM was doing better than some of the other tech stocks, and we're like, what world are we living in when IBM is the cool new revenue grower?
Is that the cool new revenue grower?
Yes.
Is that how you're describing it? Okay. Taylor, thank you. Good to catch up. Good to have you with us still into the opening bow. 3 minutes out of it. Stock's doing okay. Facebook up by, let's call it 17%. Biggest one-day pop going back to 2013, adding $76 billion to the market cap. Just like that. Deeply depressed expectations going into the print and coming off the back of it, a decent pop. Mike McKee joins us now. Mike, I think it's really important to break down this GDP number because next week is going to look pretty uncomfortable optically for the Federal Reserve. Negative GDP, inflation surging, but you break down that GDP figure, Mike, and it's less scary.
Yeah, the Fed is probably going to be okay with this. It's Joe Biden and the Democrats who have to worry because obviously this is going to be a Republican talking point. The economy grows 6.9% in the fourth quarter and then shrinks 1.4% in the first quarter. But as you say, break it down. Consumers, okay, a little bit lower than anticipated. That might get revised up, but that added 1.8% to GDP. Business spending, look at that. Non-residential fixed income up 9.2%, another addition to GDP, but inventories, $34 billion less than they were in the fourth quarter. That subtracted 0.8%, and trade, $191.6 billion subtracted from GDP because of net exports, and that subtracted 3.2%. Add that back in and you have a reasonable first quarter. So what's going on? Well, all those ships that were off the coast of California back in December and November finally landed in the first quarter, and all that stuff gets counted as imports and subtracts from GDP. We also saw a lot of inventory build in the first quarter. Stocks are full now, so we see less inventory build. So the Fed isn't going to be as concerned, because as long as consumers and businesses are still spending, they'll still be hiring, and the economy won't be as vulnerable to rate increases as you could think.
Is this easy to explain politically? Mike, on Wall Street, I understand the breakdown. I saw it from Citi, from you, Ian Shepherdson, and Pantheon Macroeconomics basically predicted it. But when a consumer already feels the way it does, maybe this GDP number is actually representative of how they feel.
Yeah, that's going to be the problem. It will be reflected in negative headlines, because most people aren't going to read the stories. They'll just look at the headlines and they'll say, yeah, I knew things were bad. It's the same story with inflation. We got an inflation figure today that was pretty awful, 8% for PCE for a quarterly number in the first quarter. Now we get tomorrow the PCE number for the month of March, and we'll see if it was going up or going down. But in either case, people are worried about inflation, and that's hard for the Fed to explain. Why, if you can get jobs, does the economy feel so bad?
Mike McKee, thank you, sir. Stay close. We'll catch up with you in just a moment. I want to cross over to PIMCO's Mark Kiesel, looking for some upside within credit markets, highlighting opportunities in consumer-facing businesses, financials, real estate, and healthcare. I'm pleased to say the CIO of Global Credit at PIMCO joins us now. Mark, great to catch up with you, sir. I want to start with this line of yours on the Fed, that they have to get back to neutral, get restrictive, and do it a little bit more quickly. Can you put some numbers on that, Mark? What do you think neutral is, and where's restrictive?
Well, John, we think the Fed will get to about 2.5 to 3 over the next year or so. I think that's roughly neutral, maybe slightly restrictive, but we've got a global inflation problem. You mentioned it this morning. German inflation up 7.8%, U.S. inflation 8.5%. So basically the Fed is playing, and other central banks are playing catch up. The good news is that the market is pricing in a lot of these rate hikes, but we really are in a situation where inflation is still significantly above trend. The labor market's as tight as it's been in basically 2 decades, and inflationary expectations are picking up. So this is a Fed and other central banks that frankly have to act, and act quickly. And the good news is that next week, in 6 days, we're probably going to get 50 basis point hikes. Remember, we haven't seen that in 22 years. So clearly, catch up is taking place, and they have a long way to go.
Mark, the market seems to be primed for that. That's what we're expecting, a 50 basis point move, another one, maybe even another one, and another one. As you indicate, once you get into the twos on Fed funds, I think that's where the uncertainty is, Mark. Can you walk me through what's shaping you and the team's thoughts on where you think it goes next? How do you come to that calculation?
Well, Jonathan, there's obviously a tremendous amount of uncertainty, particularly given the fact that you've got the war in Ukraine, you've got the COVID lockdowns in Shanghai and China. So obviously this is a market with a lot of uncertainty. But I would say the risks are that inflation will persist perhaps even longer, just because this supply chain constraints have continued to linger. If you look at the labor market, there are significantly more job openings than unemployed. The ratio is 1.8. This is a very, very tight labor market. If you look at companies, they're passing through these higher prices. What shows up on the earnings in the first quarter, very strong consumer, significant pent-up demand to travel, and most importantly, I think, is the pass-through. I think that's the inflation risk that the Fed has to get ahead of, is that companies are facing these higher prices, food, energy, labor costs, shipping, they're passing them through. And so that's why inflationary expectations have the risk of going higher. They really do need to get ahead of this.
Mark, you've got a fund to run. Your cash position has been pretty elevated. Can you help me understand where that is now relative to, say, 6 months ago, 3 months ago, 1 month ago? How's that changed?
Well, Jonathan, we've been talking for 7 months now, and every time we talk, I've been saying we've been reducing credit risk. We've been reducing for seven months, and we've been building up this cash. And the logic has been that we really have felt the Fed and other central banks around the world, Australia, Bank of England, the ECB, the Fed, all of these central banks need to get rates higher quicker because of lingering inflation, and that would in turn tighten financial conditions, put headwinds on equities and credit markets. So, you know, we think we've made the right call to get ahead of this and to really build up a big cash position. Our cash positions are quite high right now. We've also been very defensively positioned on rates, so we've been underweight duration. So we feel like we're in a very strong position of strength, but we are expecting a lot more choppy markets, more volatility, given these central banks have yet to move. So they're going to start. They've got a lot of catch up, but this is going to create a lot of volatility in markets.
How do you reconcile that view with where you like in a credit market? Because last time we spoke, you were talking about the consumer, the airlines, hotels, entertainment, in credit. Mark, if I'm thinking about a tighter monetary policy stance from the Fed and elsewhere, inflation being more persistent, can a consumer remain that resilient with that backdrop?
Well, the consumer, Jonathan, got a lot of support from the government. They're sitting on $2 trillion of excess savings. Unemployment rate is 3.6%. Wages are growing. It's the tightest labor market we've seen in 20 years. The consumer, 68% of the economy, very difficult to get a recession when the consumer is this healthy. And if you talk to companies, they're your leading indicator. They will tell you this consumer has got a lot of pent-up demand. Companies are able to pass through those higher prices and consumers are paying it. Look at airlines, look at hotels, lodging, apartment REITs. So the fact is that the on-the-ground evidence suggests that this consumer is pretty resilient. And so that's where we have invested. It's also the sector, because of this pent-up demand, because we've been in lockdown and now you're going to free up a lot of services spending, that's where we think the biggest earnings growth is going to be, and also where the best credit improvement trends are likely going to occur over the next year or so. So we have been favoring airlines, we've been favoring lodging, we also like banks, financials, and also apartment REITs because they can reset those rents every month. So as inflation goes up, they're getting higher revenue on that new lease.
Where are you uncomfortable taking credit risk?
Well, what we've been selling, Jonathan, over the last 7 months has been cyclicals. So outside of services and the consumer, most cyclicals we've been reducing. Also with energy prices where they are now, no one can predict where they're going in the future, but a lot of that credit improvement is in the past. So basically getting cyclical risk down, getting a lot of subordinated credit risk down, and basically sitting in cash, sitting in the COVID recovery sectors, and also in non-cyclical defensive sectors. So defense sector, cable, telecom, healthcare, pharmaceuticals, utilities. Those are the areas we like right now.
Mark, just how big is that cash position?
Jonathan, it's up to 10-12%. So we are quite defensively positioned. We are anticipating the potential volatility to hit markets as central banks, not just the Fed. Remember, it's a global inflation phenomenon. This is not just about the United States. Yep. Inflation is surprising high everywhere. So when this tightening of financial conditions hits, it really is going to be a catalyst for a slowdown in economic growth. And you could even see a recession in Europe as early as next year. And recession risk in the U.S. for next year are rising. So that's why we have been so defensive.
Mark, there's one place you didn't mention, Japan. And it's on our radar this morning in a much bigger way. The BOJ is committed, it says it's committed to capping interest rates on a 10-year JGB at 0.25%. The Ministry of Finance, for whatever their words are worth, are saying they're uncomfortable, concerned with what's happening in the FX market. Mark, can I just finish with getting your view on what's happening, developing in Japan at the moment, and where you and the team are at on that particular story, where you think something might break, something might give?
Well, obviously rates have been extremely low in Japan for decades and decades, and a lot of that is demographics. And their labor market isn't quite as tight as the United States. But nevertheless, again, this inflation issue is a global issue. So they're going to face higher inflation, particularly with a weaker yen. So over time, I think those rates obviously are too low as well. So in general, these developed markets, whether you're looking at the U.S., Europe, UK, Australia, Japan, all those rates are likely going to go higher over time.
Mark Kiesel of PIMCO. Mark, tremendous to catch up with you, buddy. Let's catch up again soon, just to get your thoughts on what's happening, and a lot is happening. Bit of breaking news in the last couple of minutes. Janet Yellen, the Secretary of the Treasury, delivering a bit of a speech here. Michael McKee, your thoughts on what she's saying?
Well, it's interesting. We were talking just a few moments ago about how it is a tough sell to explain the GDP contraction. It's a tough sell to explain inflation. As I mentioned, Janet Yellen is defending the Biden administration's efforts to stimulate the economy during the recession. The $1.9 trillion package that they passed, she says that and the earlier response from the Trump administration played major roles in igniting a robust recovery. The tail risk in 2020 and 2021 was a downturn that could match the Great Depression, which is why they went big instead of trying to calibrate it better. And that's what a lot of people say touched off inflation. But she says at the time, we couldn't have known that.
Mike McKee, thank you. The latest from Janet Yellen, the Treasury Secretary, who I often still sometimes am tempted to call the Fed chair. Coming up, prosecutors charging Bill Hwang with 11 criminal counts.
We allege that the defendants and their co-conspirators lied to banks to obtain billions of dollars.
That conversation up next.
We allege that the defendants and their co-conspirators lied to banks to obtain billions of dollars that they then used to inflate the stock price of a number of publicly traded companies.
Bill Hwang filing charges that could lead to 380 years in prison in the wake of his Archegos catastrophe. Hwang's lawyer saying in a statement the following: he's entirely innocent of any wrongdoing. There's no evidence whatsoever that he committed any crime, let alone the overblown allegations that pervade his indictment. Bloomberg's Sonali Bassett joins us now for more. Sonali, there's plenty of colour in this one.
There certainly is, and it's interesting to watch him defend these charges. Remember, he had gotten out on bond. He had about $100 million to be released on and pledged 2 properties to do so, John. So what's interesting here that a lot of people today are still talking about on Wall Street is the fact of how hard prosecutors came down on Bill Hwang and the facts of the case. Are they going to be able to prove criminal charges, and are they going to be able to prove intent when it comes to market manipulation in addition to the SEC case that alleges as such? The other thing that's interesting here is the fact that the prosecutors allege that he misled the banks. And how does that idea play into the other investigations that are going on when it comes to Archegos? So there are a lot of things that will be played out here legally, as you know, but questions still remain in the air. One that I like that Matt Levine has posed is, does Bill Hwang have gold bars in his backyard? Does he have money that was made from these trades that he should have paid back ultimately, and are banks going to be able to recoup any of that at the end of the day?
I have to say this is going to be a bit of an education for a lot of people. What was illegal, what was legal, what wasn't right but ultimately was okay in and around the law and the regulations. And Sonali, the final thing for me, and you touched on it, just how difficult some of this stuff will actually be to prove. Because as I mentioned, you go through it and there is tons of colour, nice little snippets, everyone's been quoting it, but how difficult will it be to prove?
That's a great question here, because intent at the end of the day is what prosecutors will be looking to prove. And watching Bill Hwang's defense will be interesting. What will he bring to the table to defend himself? He said that he would. Again, will be interesting to watch out because there are concurrent investigations going on still, including the block trading investigation that includes some of the stocks that Bill Hwang had amassed massive positions in. Just how much we saw with Discovery and Viacom and GSX, which we know a lot of other money managers had lost money on in short covering. So there will be a lot of questions going on. It's still a lot of agitas, Romain Bostic likes to say, among the money management community, but more details trickling along as we go.
Looking forward to you bringing those details to us. Sonali, thank you. As always, Sonali Basak, our Wall Street correspondent. Not a Washington correspondent, though she could be that as well. I want to bring in Taylor Riggs. Taylor, the banks standing by in Europe. I think Credit Suisse watching this one closely.
Yeah, John, I think it's interesting because we came off of here of actually decent and solid U.S. bank earnings in the last few weeks. So pushing forward to some of the European banks who, of course, as you know, were facing sort of a different macroeconomic environment given the exposure more to Russia and Ukraine. And I think what is notable here is you get Standard Chartered, you get Barclays, and of course the CEO of Standard Chartered saying that first quarter performance strong despite that volatile macro environment. We are still on track to deliver, talking a lot about some of the tangible ROE and tangible equity figures that he is laying out. I think what is interesting is not only here sort of the surprise, but of course similar story in the U.S. if you change of the board, the massive underperformance of the financials on a year-to-date basis, and yet of course sort of the big reaction here coming out of it, but a number of 0.5% to 1 to 2% here on the financials doesn't do enough to claw us out of the big hole of which they were in, and it's a similar story with technology and autos here, big underperformers for the year, trying again to catch that sort of risk on trade that you see on a day like today. It really though does sort of set us up nicely for next week. Taking a look at some of these big banks here, and of course, John, sort of the continued theme of sort of the macroeconomic environment and the ECB, a BOE, sort of hawkish pivots here that we get amidst some of the economic uncertainty still underway.
Taylor, thank you. Are you back with us again tomorrow?
Yes.
Even after calling me a boomer?
I decided to come back.
That is wonderful.
And you're not a boomer.
Thank you. Born in the 80s. Not sure that makes me a boomer at all. Taylor Riggs, thank you. Coming up, the market moving events you need to be watching. Our trading diary is up next. 25 minutes into the session, a nice pop on the equity market on the S&P 500, up 0.8%, up 1% on the Nasdaq, held out by just one single name, Meta, Facebook, absolutely surging after being deeply depressed through most of this year and then delivering some decent numbers after the close yesterday. Then it's on to Apple, it's on to Amazon after the close a little bit later. The team on the close on Bloomberg TV will run you through those numbers a little bit later. That's the price action. Here is your trading diary. President Biden discussing the war in Ukraine at 10:45 Eastern Time in about 50 minutes or so from now. Apple and Amazon reporting results after the closing bell. Those two names alone making up about 20% of the weighting on the Nasdaq 100 in just two names. Unreal. Followed by Exxon and Chevron on Friday. I'm looking forward to those numbers, just the PR around it and how the politicians respond to the profits of big oil tomorrow. And finally, we'll get a read on wages and consumer sentiment in the United States. The ECI, the Employment Cost Index, the last big one, coming into the Fed next week. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day this Thursday, April 28th. Here are the top market stories we are following for you at this hour. King dollar. The greenback is at a 20-year high with the yen the weakest since 2002 and the euro the weakest since 2017. How much further can it go? Meta's mega move. Shares of the Facebook parent soar after better than expected user growth. Twitter misses but provides no guidance with Elon Musk set to take over. Apple and Amazon report after the bell. And word from the White House, President Biden is set to speak this hour on support for Ukraine as he looks to send Congress a proposal for weapons and humanitarian aid. We'll bring you his remarks. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, it's earnings season, so usually our focus would be entirely on equities, but it's FX that gets our attention today.
Absolutely. The move in Meta is, as you say, pretty mega, but that is being eclipsed today by what we're seeing in the foreign exchange markets. Kaylee, the rate of change matters.
Yeah.
The second derivative matters here. The speed of change is absolutely eye-watering. You look at what's happening with the yen, you look at what's happening with yuan. Those two look like they're joined at the hip. I'm never going to be able to come and see you, Kaylee, because the pound just keeps getting pummeled as well. The euro's under pressure. We had a 104 handle. Have you booked your summer holiday yet?
No, but Europe and the UK looking pretty enticing for me at this point, Guy.
Absolutely, getting cheaper and cheaper.
Yeah.
It is going to have an impact back into the equity market at some point. A lot of revenue comes from outside of the United States into the S&P. But it takes us to our question of the day. The move has been brutal. It's happened quickly. It continues to move at an aggressive pace. Where does the buck stop? Let's ask that question to Vincent Signorella, Bloomberg macro strategist. Vince, is this move overdone? Like, the rate of change matters, and the pace of things moving at the moment is absolutely eye-watering.
Is it overdone? I think so. Just from a standpoint of, I think the markets are a little too aggressive in looking at 350 basis point rate hikes for the next 3 meetings. They're going to get one next week. But I have a very odd feeling, given what we're seeing in economic growth in the U.S. and the prospects of slowing in the near future, that the Fed may just walk that back a little on Wednesday, and the asymmetric risk, especially after month-end buying, which we're seeing an aggressive move in the dollar. From what I'm hearing from traders, every 11 a.m. fix, it's just simply a spike of dollar buys going into month-end. If you take that out of the equation and you have potentially, I won't say a dovish Fed, clearly not, but perhaps a little bit more to neutral than hawkish, you definitely see a reversal of the dollar a bit.
Okay, so maybe a less hawkish Fed, but you have an outright dovish BOJ still with their unlimited bond buying, trying to keep yields under control with no regard whatsoever for the Japanese yen. Vince, how much is it about yen weakness, euro weakness, not just dollar strength?
Well, I think a lot of it is not just dollar strength. When you think about where you're going to invest around the world, you see some saber rattling, obviously coming out of China, apparently not taking the step with siding with the West, but increasing trade with Russia. Obviously, the situation in Ukraine doesn't make you really want to rush into European investments, with Putin speaking about attacking those allies that are sending weapons to Ukraine. It's a much shorter road to attack someone in Europe than it would be the United States. So the more likely place for Putin, if he were to resort to some crazy retaliation, would be in Europe, not the U.S. And then you have the same situation in Asia, where there's this huge lockdown going on in China, which hurts the entire export trade, which it hurts Japan as well. So a lot of places, when you look around the world, the U.S. and Canada actually are some of the best places to be right now.
Okay, so Vince, let's just kind of break this down a little bit. How far can the dollar go? You think that maybe the Fed slows it down a little bit, but it'll be interesting to see what others do off the back of that. How far can the dollar go? Where do we get to the point where something breaks here? How close to that point are we that actually this dollar strength starts to cause a cascade effect? And you can already see some evidence of this in the emerging markets. But more broadly, that cascade effect starts to break things, meaningful things in the global economy.
You make an extraordinarily good point. It's really difficult. I mean, trying to call tops and bottoms in any market is pretty near impossible. The real wild card here is the Ukrainian situation. If that escalates to the insane level, for lack of a better word, of some nuclear option, there is no stopping the dollar. People will pile into it as a safety haven. If that situation would calm down a little bit, certainly you would have Europe become an opportunity once again, and the dollar would tail. Emerging markets are probably going to be the breaking point. If the dollar gets to a point where emerging market debt, which is largely financed in dollars, begins to cripple the EM countries, then I think you could potentially see a little bit of a turn in the dollar, because you're going to have this cascading effect of lower global growth, which will reduce inflation to some effect and then reduce some of the pressure on the Fed to push rates higher.
Well, and one of those drags on global growth, Vince, in all likelihood, looks like it may be China. And we just had the headline crossing the Bloomberg terminal, the offshore yuan dropping over 1% relative to the U.S. dollar to a session low. 665.88 is where we trade. So the weakest yuan going all the way back to 2020. Can China control the yuan, and can Japan control the yen?
China can control the yuan much more effectively than Japan can control the yen. This isn't a big deal to see the yen weakening from Japan's standpoint, from two places to be. There isn't a lot of inflation still in Japan, so a weaker yen is going to help that situation. Weaker yen is also going to help Japanese exports and stimulate the economy. So I think they're turning a little bit.
But Vince, it's gonna like the Japanese import story is starting to really hurt. You listen to what the corporates are saying. You listen to what the consumers saying in Japan. They are really feeling this. That's why the Ministry of Finance is so concerned. That's why we've got this weird tension between the Ministry of Finance and the BOJ. The BOJ is reiterating its stance on very super low interest rates, while the Ministry of Finance is out saying, look, we may need to do something about this. How does that get resolved?
Well, I mean, that is an internal situation in Japan that, has happened in the past. And, generally speaking, it's a conflict that really doesn't resolve, because there's really no middle ground in that situation. When you have a central bank saying we need to pick up inflation, we've been dealing with this for the past 30 close to 40 years, and the Ministry of Finance saying it's hurting the Japanese consumer. I mean, they may need some middle ground where you see a little bit of intervention, or obviously they'll probably try to talk it back.
Yeah, Vince, on the subject of intervention, that's not something we've seen since 1998. And when that happened, the U.S. had to play a part in that as well. Where do you put the odds of outright intervention in this scenario in 2022?
I don't think you're going to see a coordinated G20 effort, which unfortunately makes any efforts by the MOF to slow the yen weakness down pretty minimal. When one single country tries to control their currency, historically it doesn't work. You just need some coordination so that the markets believe it's a real, sincere, coordinated effort. I've seen situations in the past where I've spoken to traders when I was trading and said, thank God the BOJ wasn't buying today. There were no other buyers of dollar yen. And similar to the other side of that equation. And getting back to China, one thing you have to keep in mind is a really tight correlation between the U.S. dollar and the offshore yuan. As the dollar gains, the yuan weakens. And so as long as the dollar keeps strengthening, China's currency will weaken until the PBOC steps in to try to hold it back by putting in some sort of fixing that surprises the markets and causes those two things to revert.
You definitely got competition between Japan and China right now, both with the weak currencies. Vince, let's just talk quickly about what's happening here in Europe. The Riksbank looks like it's been pushed around by the market. The Swedes have hiked, complete U-turn. You look at what is happening with German inflation today. Like Spanish inflation still high. You've got De Guindos talking about the fact that we are near the peak, but nevertheless we're miles away from target for the ECB. Is the ECB going to be pushed around in the same way that the Riksbank has been pushed around by the market? Lagarde sounded dovish last time out. I wonder whether she can sustain that.
Well, I mean, I think she's going to try to continue to play a neutral ground, and that's been the ECB story for quite some time. You have the hawks, you have the doves, and she sort of is always seemingly in the middle, trying to bring some sort of a quorum together on that. The ECB, as you mentioned, they're still far away from their inflation target, so there's really no rush for them to be doing anything unless, as you say, the market tries to push them around a little bit. We're just noting a fade in Italian BTVs, the 10-year yield, the highest in 2 years, German Bunds crossing 90 basis points. So the market is trying to tell the ECB a story. It's a matter of whether or not they're going to listen.
All right. You know Guy Johnson will be on top of that in the next hour as well, Vince. Thank you so much to Bloomberg's Vincent Signorella. Now coming up, we'll have more on our question of the day. Where does the buck stop? Took me a while to get that one. A buck, a dollar, you get it. Guy came up with it. Got to give him credit for this question. We'll get the take from Mandy Zhu, the head of equity derivative strategy over at Credit Suisse. This is Bloomberg.
Bloomberg, the fastest numbers and analysis you trust.
It's earnings season, and there's a lot of movers in the equity market today, but really all of the focus has been on foreign exchange, which brings us to our question of the day. Where does the buck stop? Let's ask Mandy Zhu, head of equity derivative strategy over at Credit Suisse. Mandy, as Guy and I have been discussing, these moves have been remarkable. You have the dollar the strongest in 2 decades, the yen the weakest in 2 decades, euro looking like parity isn't entirely out of the realm of possibility. How do you view the volatility we're seeing in FX at the moment?
Yeah, no, I mean, not surprisingly, we're seeing a big increase in FX volatility, right? So if we take a look at the dollar yen implied volatility, so forward-looking expectations of volatility, highest since the depth of the pandemic. And this is, I would say, coming up mostly from the interest rate front, right? The fact that the Fed is going to hike very aggressively, and the BOJ has, committed to continued yield curve control. To me, what's really notable in the volatility space is not just that the FX volatility or rate volatility is going higher. I think that's very much expected, but it's that equity volatility hasn't really moved up higher in response, right? So, we've seen in the S&P a pretty significant sell-off month to date. S&P on track for the worst monthly return since March of 2020. But if you look at the VIX, it's been pretty much, in the 20 to 30 range. Yes, it has gone up in terms of absolute change, in terms of levels. It's not really remarkable, right? If you pull up a longer-term history of the VIX, what you'll see is that the current move has been, very, very moderate. So that's been
Mandy,
a source of frustration.
So do you expect it to rise? Would you expect a higher VIX? A lot of people are looking for a higher VIX as a signal to get back into the equity market. You get up into the 40s, maybe higher than that. That's going to be a signal to put some dry powder to work.
Exactly. So I think it's important to kind of dig deeper into why the VIX is as low as it is, right? Is it complacency or is it something else? And in our view, it's not complacency. It's actually mostly a function of investor positioning. So what we're seeing is a lot of investors have already deleveraged quite significantly. And by that, I mean kind of move to cash, reduce their, gross exposure. And as a result, there's less need to own options. There's less need to buy hedges in that environment. So that, I would say one is, already very conservative investor positioning. And then second, within the equity market, what we've seen this year, the big story has been very, very elevated sector and single stock dispersion, meaning we're not seeing a ton of volatility at the index level, but sectors are moving and single stocks are moving, right? Particularly right now during earnings season. So that's where we're seeing the volatility. But because of that dispersion, index vol is muted. So I do think index vol, particularly on the put side, has gone too low. So we have been recommending, investors owning some of that cheap put skew or, cheap downside put convexity. Measures of downside skew in the S&P is at a 2-year low to give you a sense of, how cheap it has gotten. But, I would say in terms of what is driving the low VIX, it's not complacency, it's positioning and it's stock and sector dispersion.
Why aren't we seeing more demand for hedging, Mandy, given all of the uncertainty out there at the macro level?
Yeah, so a couple of things. I would say, in terms of what has driven markets lower this year, I would say obviously the number one factor is a hawkish Fed and high inflation. But that's very much a anticipated risk, right? So coming into this year, I think if you were to survey most investors, people were, getting pretty bearish. I think most people expected a 5 to 10% pullback in the market on the back of higher rates, which is exactly what we have gotten, right? So nothing has been too shocking or too surprising so far. And what really drives vol, what really drives that scramble to buy hedges is when something unexpected comes up. So we're still kind of waiting for that, unknown risk to hit the market. But I think, just a hawkish Fed in itself is very much well anticipated. As a result, people are not panicking on the back of higher rates.
Mandy, what does the regional difference look like? How does Europe compare with the United States right now?
Yeah, surprisingly. So, given that we still have a war going on in Europe, given, the energy shock is much more pronounced in Europe, you'd be surprised that the volatility that's been priced into European assets have come in actually substantially. And right now, if you look at the spread between these stocks versus VIX, it's roughly flat, right? It was as high as 17 points, early on in March when Russia first invaded Ukraine. So I would say a lot of that panic, a lot of that risk premium has come out of the European assets. And, just from surveying investors and talking to investors, a lot of people have kind of put the Russia-Ukraine news kind of on the back burner and more focusing on China, more focusing on the Fed. So on the regional front, European equities, volatility has come in substantially. Where we're seeing more volatility being priced in, where we're seeing investor focus turn to right now is China. So Chinese equity volatility, versus, say S&P, that's at a high, right? That's where people are looking in terms of the next domino to fall.
Okay, Mandy, so that's the differences you're seeing on a regional level. What about just kind of within a kind of a sector level when it comes to the benchmarks here in the U.S., the VIX versus the VXN, especially around this earnings season?
Yes. So we've seen a very strong bid to tech volatility over the past 2 weeks. I would say it really started with Netflix earnings, but also, as general, rates go higher and as just general market volatility go higher, we do see, NASDAQ volatility tend to outperform. So that has definitely been the case. And then, it has been realizing, right? So if you look at how stocks have performed on the back of earnings, positive or negative, we've seen some very outsized earnings moves. So, heading into Apple, heading into Amazon tonight, we're still seeing, very elevated implied moves being priced in for those stocks.
Mandy, we're going to talk about it next. Great to catch up with you. Really appreciate it. Mandy Zhu of Credit Suisse. Really appreciate it. As I say, we're going to talk tech next. Shares of Meta soaring today. We need to dig into why. The social network adding more users than expected, but are they profitable users? Are they more profitable users than we find in the United States? We need to dig into the details. As we say, Apple, Amazon also on the docket tonight. Lots to come. This is Bloomberg. Facebook has returned to user growth. Shares of its parent company Meta soaring today. Stock's up really quite nicely. Obviously, it's fallen a fairly long way. Does this ease concerns that this is a company that has regained or lost its momentum and is now starting to regain it? Let's bring in Bloomberg Quick Takes Alex Webb. I'm really fascinated by this. I'm trying to understand, you're getting a big reaction today in Meta shares, right? Now, is that because they're down so much? Or is it because these numbers are actually actually significantly better?
I think expectations were incredibly low. There'd been a lot of stuff that was sort of telegraphed coming into it. There were some reports that they'd had a dreadful quarter. Google's numbers were a little bit disappointing, so I think people were expecting, if Google was having a bad quarter, the expectation was that on Facebook surely must be having an even worse quarter, and it didn't. And then you pair that with the fact that the valuation was at a massive discount to the rest of the tech sector, or the media sector, if you want to call it that. Facebook was trading at about 12 times forward earnings. Google was 16, 17 times forward earnings. Apple, Microsoft, Amazon way up in the 20s, 30s, and 40s. So if you compare those two things together, people think, oh, maybe Facebook was a little bit oversold. Let's get back into it. It is growing again. We value it as a growth stock. So that's why there is some reaction. I haven't actually seen the multiples for where it's at right now, given the share reaction, but it's recovered some of that, nowhere near still where Google and the others are.
Well, but talking of Google, obviously advertising a big headwind on Europe, on YouTube, with the kind of TikTok coming in to take a bite out of that business. How reflective are some of those dynamics in Meta's earnings in particular, and what, if they're different, what's driving it?
We've certainly seen a tapering of the growth there, and I think that is basically down to two big factors. Of course, the ascent of TikTok, which now has well in excess of 1 billion active users. And then, of course, the crackdown on the sort of value piece of Facebook, how it makes its money from advertising. Apple introduced the crackdown on IDFA, this way that Facebook and others track users between different apps. It's now way harder to do that. That has affected their bottom line and has affected the pace of their growth. 6% growth in the most recent quarter, not the sort of numbers we're used to. Even Apple's reporting numbers bigger than that, and it has colossal revenue. So it's clearly been a concern for investors. Nonetheless, this company is still growing from quite a high base.
In order to become Meta from Facebook, you need to invest a lot of money.
Yes.
Can it invest a lot of money at this point? Can it invest enough money at this point to be able to make that transition? Or do they need to look at ways of cutting costs? And how would that impact that transition?
So they have said that they are not going to spend as much money. The CapEx is not going to be as big this year, or their costs, I say, rather than CapEx, are not going to be as high this year as they had initially telegraphed, because revenue is not going to be as high. I think the bigger challenge is that they're having to invest in core products, their existing core products. So Reels for Instagram, which is their TikTok competitor, for instance. The challenge isn't necessarily developing the technology. They probably have enough money to do that. It's whether they can take a loss on actually selling the technology, because that's the advantage they have over Apple, that they can justify selling hardware at cost, or maybe even at a loss, with the expectation they make money on the back end from the ads. Apple doesn't do that. Apple just makes its margin on selling hardware. There are services further down the line where it makes money. That is different from Facebook. And so is Facebook going to be able to spend all that money to develop this technology and then spend money acquiring customers? Is a big ask.
Well, and even once it spends all that money, the technology is developed, are we yet understanding fully if and when the metaverse is going to be a profitable enterprise?
We don't know. And if you think even about Facebook's other efforts in, for example, commerce, Instagram shopping, they don't break that number out. That thing is 5 years old, was at one stage going to be the next big thing for Instagram. Of course, Instagram is doing very well. It is a big sizable business and making money for Facebook. But we are looking in the metaverse years and years out. I've just been speaking recently with people in Adland about the metaverse, and the key way of thinking about it is often ads in the metaverse, such as they exist, are used to sell real world products right now, not metaverse goods and services, which is what Facebook wants.
Interesting. So I'll see an advertisement for a handbag in the metaverse, and maybe I'll buy it in real life. Alex Webb of Bloomberg Quick Take, thank you so much for joining us. And coming up, we'll have more on other technology companies, big names set to report after the bell today as well, including Apple and Amazon. We'll speak with an analyst who's flagging concerns over the European consumer and their spending on Apple products. Baird's Will Power will be joining us next. This is Bloomberg.
At that all day yesterday.
We are an hour into the U.S. trading session. Stocks are higher, but off of the highs. The S&P 500 right now up about 0.3%. The NASDAQ 100 outperforming, up about 0.6 after some of the results we got from tech companies after the bell. I'll have more on that in just a minute, but the interesting thing today, Guy, is that it isn't really a story so much about the equity market, even in light of all of the earnings we are getting. It's not even about the bond market with yields up a single basis point on the 10-year to 284. It is really about foreign exchange, with the dollar at its strongest going all the way back to 2002, a 103.70 on the dollar index. And of course, it's part dollar strength, but it is also part weakness of other currencies, including the Japanese yen. You have a BOJ that is consistently pushing its dovish policy with unlimited bond buying, trying to keep a cap on yields, no matter what happens, really, to the yen. And as a result, you're seeing the yen out at a 2-decade low against the dollar. A 131 handle is where we are at the moment. Finally, though, we do, of course, have to take note of the earning movers that are out there. We were just talking about Meta. The bar was really, really low, so that small beat on user growth enough to send the stock higher by about 12% today. The bar was also low for Pinterest. This is stock down 49% year to date as of yesterday's close, but with better than expected results after the bell, that stock is higher by about 4%. And you have Qualcomm higher as well, Guy. This, of course, is the biggest chip maker for smartphones, gave a really strong forecast indicating some good things about demand for those products.
Bit of political news, Kaylee, right now. The Biden administration is briefing on a request that has been made to Congress by the administration for additional funds to support the effort in Ukraine. The Biden administration is going to ask Congress for an additional $33 billion in emergency funding for Ukraine. That request includes $3 billion for global food and humanitarian aid. The budget will cover, according to the Biden administration, around 5 months of the war. As we've seen that happening, we've also seen data coming out from the EIA on U.S. natural gas stockpiles. They picked up a little bit. We'll be talking to EQT in the next hour to get its take on what is happening in that nat gas story in the United States and what is happening out of Ukraine in terms of the implications. But in terms of what we're getting from the Biden administration, an additional request for $33 billion in emergency funding. We'll come back to that story. Let's talk the tech story right now. Apple is amongst the tech heavyweights that will be reporting results later today. Joining us now, Will Power of Baird. He has an outperform rating on Apple. He has a $90 price target. Apple, as you can see, is trading significantly above that. That seems to be slightly off base. Will, talk to us about what you're expecting, what you think the share price is going to look like post these numbers.
Yeah, well, Guy, we're at a $190 target price, so we do still see some long-term.
That seems a little bit more logical than what I saw on the screen in front of me.
we do still see some long-term upside. Look, we're looking for another strong quarter from Apple. All that said, the growth we do expect to moderate. They're clearly coming out of some tough comps, some pandemic, benefits as you look at the strength they've had over the course of the past year. But I think generally, we investors expect, a very good quarter. I think the big question is going to be, the outlook and how much are they impacted by the growing macro risks across Europe, supply chain issues in China, coupled with the fact that, they are trading near historic highs relative to the S&P 500. So while the stock is down, it's performed better than many of its peers in the broader market, suggesting a bigger premium than we've normally seen with the stock. So that creates a little additional risk, I guess, into the print.
So how large would the beat need to be to actually see a reward for the shares, Will?
Well, I think investors are expecting at least a modest beat, right? I mean, at least several percent. But again, I think, Kaylee, the bigger question is going to be comments on the forward outlook. Because look, the company generates almost a quarter of its revenue from, EMEA. So it's got a fair amount of exposure to Europe. Now, Eastern Europe, where I think the bigger headwinds are right now, less so. But of course, it's got another, 20% plus tied to, the greater China region. And with lockdowns there, that creates questions both on demand and supply. And so candidly, I think that's really where the focus is going to be, and what do the guidance parameters look like around that?
What would be a good entry point? You've got a 190 price target. We're trading obviously south of that right now. Where would you get into this stock? Would you be anticipating that we are going to get a little bit of volatility in Apple and there will be good entry points? Just sort of tactically, how do you think about the stock?
Yeah, no, Guy, I think that's a great point. And I think, one of the headlines from our preview note for Apple is we'd be more aggressive buyers, on weakness. I think the risk reward tactically into the quarter probably isn't as favorable as it's been, given some of the parameters I just laid out, some of the risks that are in front of them with respect to guidance and a valuation premium that's at the high end relative, to the broader market. All that said, we continue to like the story longer term. So we like it from these levels. We just be more aggressive, if there were any weakness. And this is still a story that we think should continue to benefit from the broader ecosystem strength, services, still just 20% of revenue, but growing at a high teens clip. Of course, they're generating strong growth in wearables. So this is still very much a story long term, built on the foundation of a strong ecosystem. And we think it's still a multi-year 5G tailwind on the iPhone front.
Yeah, well, we've talked a lot about, the 5G-driven upgrade cycle. I'm wondering, though, you mentioned kind of the supply and demand challenges in China, but just thinking demand more broadly, given the inflation that consumers are facing, are they going to be as likely to upgrade the iPhone if theirs still works perfectly fine, to buy that Apple Watch? I mean, how are you thinking about that here?
Yeah, no question. I mean, there's some real questions there. I think the biggest inflationary risk, at least near term, is probably in the EMEA region. We're seeing inflation in the U.S., that we haven't seen the consumer impacts, I guess, manifest in a major way yet. But there's still more to that story probably to be written over the next 12, 18 months. But thus far, Apple's been very resilient, right? It's been a necessary product in this work from anywhere world. And we still think the demand trends overall look good from a competitive standpoint. They still stack up, as well as ever. But without question, those inflationary risks more broadly will be something we'll have to continue to monitor.
Will, what's your degree of certainty in valuing the services business? Because this always seems to be the bit that everybody struggles with right now. When you look at that business, you talked about the growth rate just a moment ago. How are you thinking? What kind of multiple do I put on that services business?
Well, that's a great question, Guy. There's not a perfect answer. I think, typically what you do is probably look at some of the other big cap, more services-oriented entities. Now, many of those have been, under pressure, certainly, likes of Netflix, Facebook, others. But keep in mind, this is a business that's pretty unique in the respect that it's going to probably break through $20 billion of quarterly revenue. So you're almost at a $100 billion business, 70% gross margin. This is a company that in total, right, is going to generate close to $100 billion of free cash flow this year. And that's been the key to the story, right, to the PE accretion, to the earnings multiple accretion that's occurred over the last several years is in large part, I think, been driven by the strength of that services business as it continues to shift away from a business driven by more hardware-centric products. So there's not a perfect answer on it, but without question, as that becomes a bigger part of the business, that's helped support a premium to the broader market.
Well, and let's talk about one business within the broader services basket, Will. Apple TV Plus. We all saw what happened with Netflix. The streaming environment is getting more competitive, and it is starting to take a toll. How do you view that in particular?
Well, it's still a small piece of the business. And Kelly, I don't know how much you've watched of Apple TV Plus. I mean, they don't have anywhere near the
morning show, Will. It's one of my favorites.
Yeah, look, I mean, they actually have some pretty good programs, right? I mean, whether it's Ted Lasso, The Morning Show, and they've had some nice, kind of sci-fi related hits, some documentaries in there. I think they've actually done, a fairly nice job given much more limited spend overall than where Netflix is. But again, it's part of the ecosystem basket, and I think our expectation would be Apple will continue to invest in that to just drive more people, to the broader platform. It's not something that's a needle mover one way or the other on this quarter or the next quarter. It's still, still much too early.
Kelly gets to live the morning show on a daily basis, so she has some sort of affinity for that product. Where are we going with health, Will? Because there are areas within Apple that you can see having real growth potential that haven't fully been realized yet. We often talk about what happens with the car story, the also kind of endeavors that ultimately could or could not work at Apple. But health looks like an area they have the potential to really grow in. Where do you see the growth coming through? Where are the areas that are untapped by Apple that investors should be looking out for next? This is a company that struggles to make acquisitions. It has to be organic in many areas. Where does that organic growth come from next?
Yeah, Guy, that's a great question, and I think you hit the nail on the head. I mean, I think healthcare, without question, is one of the key areas of focus within the company. I mean, I think Tim Cook kind of has trouble hiding his enthusiasm around some of the opportunities they foresee. I mean, today, as you probably know, just as a consumer, I think a lot of it's been driven by Apple Watch and the capabilities that enables. But they clearly plan to move further just on Apple Watch alone. But I think they do have broader aspirations as pertains to healthcare. But I think that's just one piece of the future products. They want to do more in financial services and around payments, right? To build off of Apple Pay and Apple Card. I think there's more to come on that front. And I do think there's probably still more to come on autonomous vehicles. This is a software-driven market, and that's obviously a big addressable market opportunity longer term for them. And that candidly, that's part of the bet, and the reason investors still pay a premium for Apple is some of the products that are yet to be announced, right, that we think are still on the come.
Well, as we're talking about Apple and healthcare, my producers are reminding me of the days back when I was in the control room and I used to stand up once every hour and wave my arms around to try and get a standing ring closed on my Apple Watch. One final question. We've talked about all of these businesses driving growth for Apple, services, hardware, Apple TV Plus even. That generates a lot of cash. Apple has limited ways to spend it given the regulatory environment. What is your thesis around buybacks for this company?
Well, they've been aggressive, as I'm sure you know. We'll probably get an update perhaps out of this quarter. I think it was just a year ago that they increased the buyback by around $90 billion. My expectation is you could see something similar to that again, along with the dividend increase. And that's one of the attractive features of the company, right? It's got that defensive quality with respect to the amount of cash it generates. Again, we're expecting close to $100 billion of free cash flow this year. And we think a big chunk of that will be allocated to the combination of buybacks and dividends, given the fact that they haven't had a big appetite for big M&A. But that's always something I'm sure they could still consider. But we still think buybacks will be the biggest focus.
All right, we'll leave it there. Thank you so much for joining us, Will Power, Barrett Senior Research Analyst. Now coming up, we'll turn from Apple back to politics. We're waiting to hear from President Biden, who will make his case for more military and humanitarian aid for Ukraine. Again, the headline just crossing moments ago that he will be asking Congress for $33 billion in emergency funding. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. In Germany, lawmakers are urging the government to quickly supply Ukraine with heavy weapons and other equipment. A motion in Parliament Thursday night also called for an end to imports of Russian oil. Chancellor Olaf Scholz has faced intense criticism to do more to help Ukraine. Moderna has asked U.S. regulators for emergency use authorization for its COVID vaccine for kids ages 6 months to under 6 years. A successful trial showed 2 doses generate high levels of antibodies to the virus. There is currently no vaccine approved for those under 5. Chris Paul is a future NBA Hall of Famer. He is also a businessman and investor looking for smart ideas and advice on business, leadership, and growth. And he's bringing that search to Bloomberg Quick Take and his new show, How I Got Here. This week, Chris Paul visits Byron Allen's entertainment studios to hear about the CEO